Earlier in the year, the UK had record-breaking inflation, with both headline and core inflation remaining well above the government's target of 2%, and often it was much worse than economists forecast. As bad news kept coming in, the Bank of England increased interest rates 14 times. Finally, in a narrow vote, the bank decided to pause interest rate rises this month. But in the coming months, all the past interest rate increases will increasingly affect and slow down the UK economy. And the big question is, will all these past interest rate increases push a fragile UK economy into recession? And does it mean that interest rates have peaked? Have the bank even increased interest rates too much? Or will inflation continue to be a problem? Last month, inflation fell. It was better than economists predicted. But whilst the graph looks encouraging, the reality is that prices are still rising by 6.5% a year. And by the way, in the US, where inflation rate has come down quite a lot, no one really is celebrating because consumers are still adjusting to the much higher prices. Always worth bearing in mind, a fall in inflation means prices are still rising, just at a slower rate. Also hidden in last month's inflation data was a 60% rise in mortgage interest payments. This is the biggest jump in mortgage costs since 1989, just before the housing crisis of the early 90s. For homeowners, mortgage payments as a share of income have risen sharply, squeezing household incomes at a time of real cost of living pressures. Now, although fewer households have mortgages than in the 1990s, there's little respite for those in the private rented sector, because we've seen a record-breaking 12% rise in rents this year. Rents have been rising faster than earnings, worsening affordability for those in the broken rented sector. Also, it's worth bearing in mind that this big jump in interest rates from 0.5 to 5.2 is more pronounced than in the past. I mean, people often say, well, in the 90s, interest rates were 15%. But back in the early 90s, the average house price was £55,000. In the past few decades, the surge in house prices and the typical mortgage value means that even a 0.5% rise in mortgage interest rates would cost householders £60 a month. So if interest rates double from 2.5% to 5%, that's a really big increase in mortgage costs and decline in disposable income. But the real problem is that the past interest rate rises have still not been fully felt in the economy. Many homeowners have been insulated by the bank's past increases by having a 2-year fixed mortgage. But over the next 12 months, millions of homeowners will face an acute shock as their living expenses are massively increased as they remortgage to higher rates. Even if the Bank of England had actually cut interest rates this month, it would still be the case that millions will be facing higher mortgage payments next year. And with homeowners facing an extra up to £500 a month extra mortgage payments, real household income will be squeezed next year. And even if the UK technically avoids a recession, it won't feel like that for millions of householders. Not only do homeowners face rising mortgage payments, but also we're seeing house prices starting to fall, creating a negative wealth effect, low confidence, the possibility of negative equity. Now, last year, the Bank of England were actually forecasting a recession for 2024, a prolonged recession. But the UK economy has been unexpectedly resilient, avoiding a technical recession. But given the squeeze in living standards and falling real wages, how did the UK avoid a recession? Well, firstly, if we look at GDP statistics for this year, we see a real stop-start pattern. It shows, firstly, you have to be careful about extrapolating from 1 month's data. But I think the underlying picture is one of economic weakness. There's no momentum in the UK economy. This gives a bigger picture of its real GDP per capita growth in recent years. And by the way, it does include recent upward revisions to GDP, which aren't particularly noticeable. And this is the bigger picture of a UK economy. An economy which has not got any momentum, economic growth very weak, and the past trend rate, which we saw for so many decades, has really been broken. And for those struggling to meet cost of living pressures, talk of avoiding a technical recession will be of little comfort. Many households are dealing with stagnant real wages, inflation, higher taxes, and now higher interest rates on top of it. What about the outlook for inflation? In the early part of the year, inflation often exceeded forecasts, and core inflation continued to rise. It looked like a real inflation problem. Also, after months of falling real wages, nominal wages have started to catch up. Nominal wages grew 8% last month, and this will be cited as evidence that higher interest rates are still needed as inflationary pressures may become embedded. The economist Nouriel Roubini has been very bearish on the European economy, suggesting that it would be very difficult to get inflation back to 2% because of rising commodities, and he points to the fact that oil prices have recently rebounded. And although it has faded somewhat from headline news, the Ukraine war will continue to put upward pressure on commodity prices in the coming months and years. This year we had a real relief from falling gas prices, but there's no guarantee that will continue, especially if we get a cold winter. Now, Roubini argues that central bankers should increase interest rates even more to get inflation back on target of 2%. However, this strategy really does risk pushing the economy further into recession. And I think also the outlook on inflation does definitely look more promising than say at the start of the year. Since midsummer, inflation has started to undershoot expectations, starting to fall a bit faster than people predicted. The retail group Next produced an interesting report where they expect inflation to fall sharply during 2024. They predict their prices could even fall. The ONS report a similar improvement in optimism, with a steady decline in the number of firms expecting price rises. And if inflation does fall, like the Bank of England predicts, it may lead to finally positive real wage growth. And this would be definitely good news for the economy. But it is worth bearing in mind, we've had quite a few years of either stagnant or falling real wage growth. So it'll take a lot of time for workers to catch up all the lost wages over the recent few years. Now, interestingly, the Bank of England's own inflation forecasts predict that inflation could fall below target by early 2025. But here's the thing, interest rates can take up to 18 to 24 months to have an effect. So the interest rate changes we've seen around now will be still affecting the economy in 2025. But are the rise in interest rates the right response to potential disinflation and a likely recession? Now, you may well be sceptical of an inflation forecast for 12 months hence. Past predictions have been pretty offbeat, you could say. But if we do take a look at the real economy, confidence is still very low. Towns have been hollowed out by the decline of retail shops. The bankruptcy of Wilko is a good example. Unemployment rose for the first time in August for quite a long time. And also, the higher interest rates, which are really squeezing homeowners, will also affect firms because their borrowing costs will rise, discouraging investment, which is pretty weak in the UK ever since 2016. So given the weakness of current UK economic growth, it will be interesting to see how all the recent rises in interest rates, which were very quick, will affect the economy in the coming months as people remortgage and firms face higher borrowing costs. And I do feel there's a real danger that in 2024, the delayed momentum from higher interest rates will affect the economy more than some people predict. And then the concern will not be meeting the arbitrary inflation target of 2%, but other concerns like unemployment and economic growth. Now, Roubini, inflation hawk, he argues that if we don't get inflation down to 2% quick, it will cause an embedded wage price spiral as inflation causes workers to push up wages and cause more and more inflation. But I don't agree with this analysis because I don't see any evidence really of a wage price spiral. It is not wages causing inflation, more the other way around, but workers are belatedly trying to catch up with inflation. I think that workers' bargaining power is fairly weak, and that's why we're seeing so many strikes, because people are fed up of real wage cuts. And if inflation comes down, I think that earnings growth will also start to slow. So what will happen to interest rates? Well, the Bank of England may make one or two more small increases in interest rates, but I think we're pretty close to reaching the peak. I think that next year the economy will slow down, inflation will be much less of a problem, and there'll be no need to increase interest rates to bring inflation down. In fact, the Bank of England perhaps have raised interest rates too much. We'll have to wait and see next year, but one thing's for certain, we could be seeing positive real interest rates for the first time in many years. That means that interest rates will be higher than the inflation rate, and that might cause quite a shock to business and households who have become so used to the past climate of negative real interest rates. So overall, it is too early to declare victory on inflation. Core inflation is still running at over 6%, and that's a big problem. But because of the weakness of the economy, because of the past interest rate rises, there will be many disinflationary factors affecting the economy in the next 12 months. So inflation is likely to fall. Unless there's some unexpected rise in oil prices back to $150, then I think that inflation will fall. But the big question is, how will homeowners, business, even government be affected by such an unexpected and large increase in interest rates? Because don't forget, we've had 15 years of pretty much zero interest rates, and this is a real shock in interest rate changes that we haven't seen for a long time. So it's going to have a big effect on the economy, and there's a degree of uncertainty what will actually happen. Anyway, if you enjoyed this video, check out this one on the comparison between the Irish and UK economy. Very interesting. Do watch it all the way through to the end. Thanks for watching. Cheers. Bye.